I think there's good news on growth. The economy is recovering. I always say, though, at this point, that good news has to be put into context. As of now, the level of economic activity is still about 4% lower than it was at the end of 2019, pre-COVID. Now, in any normal state of the world, that's a big number. I mean, it's only not a big number in the sense that we've had such huge gyrations in the economy over the last 18 months. So, we still have 4% to catch up. And even then, of course, we've had no growth over nearly 2 years. So just put it into context. But this recovery, this bounce back is good news. I think it's particularly good news on unemployment because we've reduced our forecast for unemployment and really given it a very different profile, which is we think it's going to decline from here on. And in all honesty, I mean, conversations we were having a year ago, I mean, if you'd said to me this is going to be the profile of unemployment, I would have A, said I doubt it, and B, that would be terrific.
So is that the justification for continuing with the asset purchase program until the end of the year then? Because, the alternative view is, well, your growth forecast is still pretty high. You've upgraded the growth forecast for next year, and you're anticipating higher inflation in the fourth quarter and the first quarter of next year. Why would you still need to provide extra stimulus to the economy? Well,
just focus on the inflation point because that's very important, as you say. So yes, we are forecasting, a hump in inflation. It's going to rise, but we think it's going to be temporary. And in the sort of second half of the outer part of our forecast, we think it comes back to target. And putting it into the context of the decision we took on monetary policy, that's very important. That we think, our best assumption is that inflation will return to its target.
So let's talk about the inflation outlook then, because you have used the word transitory today, which is the word that many other central bankers have been using.
Yes.
And there are clear signs that there are industries that are affected by supply bottlenecks, or the industries that are witnessing high levels of price increases are the ones that are affected by the pandemic. Are you seeing any signs of secondary effects when it comes to pay growth? And the reason I'm asking that is because you just talked about how your unemployment forecasts are a lot lower than they were before. So how are you squaring the two up?
So several parts to that. It's very hard at the moment to sort of disentangle the pay story. For the reason that in this country, a year ago, average earnings were negative, which is it's an unusual event. But of course, it means that the percentage increase from then to now is much higher. And I've said a few times actually in the last few months that if there was no increase in pay in this country for the rest of this year, we would still have pay growth of 8%. And that's a big number by any normal or historical standard. So you have to put it in that context. The second thing is that the composition of who's in the pay growth statistics has changed. There's a compositional effect that the people who are in the pay growth statistics at the moment are people who tend to get higher pay increases. That's because of COVID. The impact it's had on people, the lower paid people, particularly in service sector. So again, you have to sort of factor that in. Now, we've done our best to sort of take all of this apart and say what's going on underneath. And yes, there is reasonably robust pay growth. The big issue at the moment is that we've got an increase in vacancies. And we need the labour market to now start bringing people coming back into the labour force and filling those vacancies, because if that doesn't happen, we will get paid.
There could be a mismatch, yeah. Let's talk about the policy guidance review. A question I asked you in the press conference, and you articulated very clearly that one should not perceive the balance sheet reduction to be a substitute for rate hikes.
Yeah.
Why is balance sheet reduction a priority right now? Why are you so focused on it, and why did you make this announcement today?
Well, my view, by the way, of course, today we've not announced that we are reducing the balance sheet. We've
of course, you've changed the guidance. Yeah.
And I think it's important to give, to make that predictable, to give a degree of certainty to how we will respond to that. I also think, as a central bank, of course, we're not alone in this. I mean, other central banks are in the same position. Our balance sheets have expanded very substantially as a result of the necessary actions we've taken in terms of asset purchases. Our balance sheet is, I think, it's over 40% of UK GDP now. By historical standards, that's very big. Now, we may have to do this again if we get some unpredictable shock in the future. And if we're going to use this as a tool of counter-cyclical economic policy, which we have been doing, then I think we have to be very cognizant of the size of the balance sheet. We have to manage the size of the balance sheet more counter-cyclically. So we have to have in place policies that say, during the good times, during the recovery, here's how we will reduce the size of the balance sheet. And for me, that's very important because I've got to plan for the future about how we meet unknown future events. Yeah, we've had two very big shocks in the world economy in the last 15 years. We've had a global financial crisis, we've had a pandemic. I mean, one of the big messages for me out of that is we've got to be prepared. We don't know what's going to happen, but we've got to be prepared for things to happen.
So just to pick up on that then, in response to the question that I asked you in the press conference, you suggested that the reduction was occurring at a lower base rate, 0.5% rather than 1.5%, because 1.5% is still some far away from where we are right now. Does that tie in to your assessment of where you see R star?
Well, first of all, the market curve, of course, doesn't get to 1.5% in any foreseeable future. So that's relevant. Is it relevant to R star? Yes, it is, because I think if you look at the longer term issue here, we've got a very low level of R star, which the equilibrium interest rate, which we think will continue, because the reasons for that are structural in the world economy. It's a lot to do with aging populations, to do with patterns of saving, and we think that that's not over by any means. So yes, there is a link here between those two things.